Motilal Oswal's head of research, Gautam Duggad, whether the outlook remains cloudy or does it improve. To his credit, at the end of Q1, he did say that the earnings picture looked a lot more sketchy than what it was at the start of the year. Gautam, good having you. Thanks so much for joining in. From a Nifty or a Sensex EPS perspective, has the picture gotten sketchier?
Hi Neeraj, good morning. Good morning to your viewers also. See, this quarter's earnings, one has to say a thing that, it didn't turn out as bad as one was fearing 40 days back when the environment was all hazy. You had crude going up, currency very volatile. There was a scare of NBFC liquidity tightening and ILFS default. Investors were quite concerned how this quarter will pan out, and more importantly, how the commentary will be. At the end of the earnings season, one has to say that this quarter's earnings met the expectations. On earnings, we have grown around 12% on Nifty versus the expectation of around 12% only. So it is in line, and EBITDA has been slightly ahead. Top line has been pretty strong, 2-3% ahead of expectation, more than 20% growth. So for the quarter at least, it has gone down reasonably okay without much of an accident. What remains a problem area, however, is the earnings downgrade. That has not come off. In fact, we've cut our earnings estimate for FY19 by 4% on Nifty. And if I were to take a slightly, stretch it to April, in the last 6-7 months, we have seen almost a 10% downgrade on Nifty earnings for FY19. So we are now at around 515 rupees versus 590 at the beginning of the fiscal year. So earnings downgrade have continued, but the quarter has come out quite well. And of course, the earnings downgrade were led by 4-5 commodity companies. So it's not a broad-based earnings downgrade, so to say. But the fact remains that earnings are still in a downgraded, scenario rather than stabilizing or, dreaming about upgrades. So that is point number one. Secondly, the picture obviously is slightly more hazier given the events of last 40-45 days. But we must also acknowledge that there has been a lot of stability now, whether it is crude, whether it is currency, whether it is bond yields, or even for that matter, the problems which were pertaining to the NBFC sector. Things haven't turned out as bad as people were fearing on NBFC front. They seem to have got money, rollovers have happened, maybe the cost of funds have gone up, and probably some amount of growth may taper for them, but there has not been any big accident as people were scared about a couple of weeks back.
Okay, that's heartening to hear about the roles as well. But since we're talking about earnings, I want to check with you about what stood out for you from an earnings perspective this time around. Was it banks and corporate-facing banks, or was it something else?
Absolutely. Corporate-facing banks were the standout for this quarter, is the highlight of the quarter. We all have been hoping for the peak of the asset quality cycle, and it seems that we've got that. Commentary was pretty strong too. The moderation in fresh slippages, peaking of bad asset cycle, strengthening of provisioning coverage ratio, and the whole environment is right now conducive for the banks. It seems that there will be some market share gains for the banks, and of course more for well-funded high CASA banks. So clearly valuations are also in their favor. So you will see a lot of portfolio shifts happening. In fact, they are already underway. If you see the data of October month of a lot of mutual fund portfolios which has come out. So clearly shift is there from some retail-oriented private banks to corporate-oriented banks, given the change in the environment and also the relative valuations which are in favor of corporate banks today. So that has been the standard. And second standard obviously has been metals, which has once again surprised, and the quantum of surprise has been pretty big. 60% profit growth for our universe versus the expectation of 40%. In fact, at the time of preview, if you remember, we discussed that large part of the incremental earnings for this quarter will come from commodity and oil and gas, and that is what has exactly happened. 75% of the incremental earnings growth that we have got this season is from metals and oil and gas.
The other pockets of concern, mainly obviously price-led, was the cement pocket, which disappointed on the realizations. Auto as a pocket, high raw material costs, delayed festive season, that weighed down. Individual stocks had their own stories, like for Tata Motors and JLR. And pharma as a pocket, Cipla disappointed. Sun Pharma wasn't up to the mark. How did you read into all of these?
See, barring cement, rest was factored in. I think auto, we were expecting a flattish kind of performance for our universe, excluding Tata Motors. And same for pharma. We were expecting around 4% profit growth. We got around 7%. So pharma and auto I won't categorize as disappointment versus expectations. Cement was a big disappointment versus even expectations, which were muted. And what has happened in cement is, while volume growth was pretty strong across the board, the cost pressures have come to the fore, whether it is freight cost, whether it is the whole power and fuel costs. That has spoiled the story for the sector, and I think valuations were also quite high. The sector remains a function of three parameters, which is volume, pricing and cost, and at any given point of time, one of that three parameters is not in its favor, and that spoils the earnings show for them. So this quarter was no different. Autos, clearly, I mean, what is more important right now to focus on from a next 6 months or 12 months perspective is how the volume trends shape up. Cost pressures have gone up, whether it is insurance costs, whether it is raw material costs, or even for that matter, the interest cost, which has gone up. And there is a fair bit of financing element which is embedded in auto sector growth. So one has to wait and see how that pans out. But a lot of stock prices have corrected in that space. And some of them, I mean, stocks like Maruti, which has always been our favorite, that has seen a significant correction. And I think while I do not have any visibility of next 3 months or 6 months of performance for this company, given the very solid franchise that they have and improving free cash flow dynamics and ROICs there, I'd be very interested in looking at such names.
Well, the currency depreciation only compounded the problem for some of these, pockets. But moving forward into the next few quarters, do you see these pressure points continuing to weigh down on the earnings?
See, one of the most important imponderable today is crude oil prices, and now we've been very lucky. There has been a $20 drop in crude oil prices suddenly in the last 30 days, while everyone was talking about $80, $90, $100. The prices as we speak have settled around 65 to 67. Now it is important to see how long they remain in this range, and given that there are already talks about supply being curtailed, one has to wait and see how the crude oil prices behave and where do they settle, because it has strong implications for currency, very strong implications for inflation and current account dynamics. And coming to the earnings, it obviously has implication for earnings of sectors like consumer, sectors like auto, sectors like cement. So that can have a significant downside risk. But as of now, clearly, as we spoke in the beginning, crude oil prices have settled down, currency is stabilized, and bond yields have also come off. So a lot of negative risk for the earnings, which were staring at our face 30 days back, they seem to have dissipated for the time being.
Gautam, what stocks stood out for you in earnings? I mean, surely you looked at the entire space of those 180, 189 or 190 companies that you guys have, but there must be those 3 or 4 names where the earnings delivery really stood out for you. Which were those?
So I think, let's start with banks. Banks, as I said in the beginning, private corporate banks were the single, surprising factor. They've surprised on the asset quality front, given the muted expectations. So they are one of the biggest positive factors emerging out of this earnings season, whether you look at ICICI, whether you look at Axis, and possibly even SBI for that matter. And that's what I said, that there will be portfolio shifts which will happen going forward, given that people are heavily overweight on, or rather they were heavily overweight on retail-oriented banks, and there was substantial under-allocation towards private corporate banks. So that part of the portfolio shift you will see, continuing. Another stock which stood out for me, and we've always talked about it, was Titan. The whole story of unorganized to organized is playing out to the script for them. It's one of the single largest beneficiaries of the entire GST and formalization of economy. This quarter's numbers were outstanding, whether it is on jewelry front or even on watches front, and the guidance remains very strong. They've seen 30% growth even for the 40-day festival period that we have seen from October to November. So I remain a very strong believer in that story. I think the stock has a very strong potential to deliver outstanding returns from a multi-year perspective, given that the unorganized trade in jewelry is still not able to find its act together. Then there are pockets, where we have seen decent performances. Stocks like Nestle, Hindustan Lever, they went pretty well. And then, of course, IT sector was pretty strong, at least the tier 1, where the expectations were met, 18% growth, which is the highest in many quarters on profit front. Just that stocks had rallied, so there is some cool off that we are seeing there. But it's a good opportunity to get into some of these large cap names. Stocks have corrected 10 to 15%, whether you look at TCS or Infosys. Numbers are solid, commentary is pretty strong too. Just that incrementally your rupee support has gone out now, but fundamentals remain pretty healthy for them. And plus you are seeing capital being returned to the shareholders. So that is always healthy from a valuation perspective. So those are 3 or 4 pockets. Metals have done well, but I remain very cautious on metals from last many quarters, given that we are towards the fag end of the upcycle now. And therefore, while profits look solid, possibly the valuations will not have the same reflection. And that is where one need to be a little more cautious.
Yeah. Just want to pull out Jet Airways. The stock is now up about 8% odd. It was a different scene altogether at the start of trade. The stock was down closer to about 3.5%, now trading higher by 8%. So there is some interest that's coming back in, and those targets of 350 look like they're going to be met anytime soon. Gautam, while obviously the setbacks were pretty known in terms of the earnings from the aviation space and what would cause a drag and a bleed on profitability for some of these names, put together 2,600 crores of losses this quarter. That's one of the highest that we've seen in about 3 odd years. What's the way forward for aviation, and what are the crucial aspects you're going to be watching out for?
Aviation, we cover only Indigo, and Indigo reported losses. Numbers are pretty bad given where the crude oil prices were, but the fortunes of the sectors are closely linked to the crude oil prices. Now, this is where the dichotomy is. While the consumer growth, the passenger growth is very strong, the pricing power is just not there, and there is a huge supply which is coming out. So I think this sector has become a lot more like a trading sector. You take a call on crude oil price and play, rather than worry about next 3 or 5 years, because the macro looks very rosy for them. The passenger growth has been more than 15% for the last 40-45 months. The point is that that growth is not flowing down to the top line because of a host of factors, whether it is related to cost or whether it is related to pricing. So I would avoid that sector, given that I have no clue where the crude prices will settle, and I see no improvement in pricing power in the near term. While it can give a trading returns, but from an investment viewpoint, it still remains a very tricky sector to tackle.
Okay. Gautam, earnings versus the market trend for oil marketing companies. What happens here? What's your outlook?
So I think large part of the reaction of OMCs is largely done, because that is flowing from where the crude oil prices have been. Again, on OMCs, just like what I said on aviation, this remains like a trading pack. We are very closer to the election period now for the next 6 months, and the market is quite concerned on the whole regime of deregulation, given the price cut that we have seen, which has come out a month back. I think that the reflection of crude oil prices will be far more dominant on the trading pattern of the stocks than anything to do with fundamentals at this moment. So the short-term direction of OMCs will be a function of where the politics settle down in the next 6 months, depending on the series of elections that we have, and also where do crude oil prices finally settle. So if crude oil prices settle around 65-70 band, then obviously valuations look quite attractive for them, given that they're trading at sub 1.5 times price to book.
Okay. Gautam, before we wrap up, that one space post earnings that you believe is a complete avoid?
So I've always believed that a couple of spaces like telecom, cement, those are spaces where one needs to be far more sure of the structural change in the earnings before one takes an exposure there. So telecom, you see the size of the balance sheet debt, it's quite scary, and the competitive intensity refuses to subside. So that is one space where I'll be extremely cautious. Second space, as I said, is cement and metals, where cycle somehow is not favoring them at the moment, and then there are a host of other concerns on pricing. So that is the second area where I have to be cautious. And third is, of course, the consumer stocks, where the valuations have not left anything on the table. While I'm positive on consumer space from medium to long-term perspective, but from the next 6 to 9 months, I think this space can have a time correction, because while earnings have been pretty solid, we've got 15% earnings growth, 14% EBITDA growth this season for the consumer space. The valuations are discounting a lot of that, and there is no room for disappointment. We saw what happened with Page last 2 days. There's one quarter blip and stock has given 12-13% correction. So there are bottoms of opportunity in that space. We continue to like Titan, we like Pidilite, we like Britannia and Hindustan Lever, but large part of that space at 50 times FY20 earnings looks like one can wait before one enters that space afresh.
So good. My last question, actually, since you brought it up, post earnings, Page, the ever favorite, has it started looking a bit dicey to make a fresh investment in?
Not at all. In fact, the story remains as solid as ever. This is just one quarter of a blip. The management said that I think it is due to festive season mismatch and possibly you will see a bounce back in Q3. What I was referring to was the valuations. At 70 times FY19 and 52 or 53 times FY20, the room for disappointment for somebody looking at a short-term return is just not there.
But Gautam, sorry, Gautam, if I can come in, that's my question really. If one quarter of an earnings miss, or could there be more, and therefore would the multiple come off to your mind from those 70, 80 times to maybe 50, 60 times?
Possible. I cannot deny that possibility is staying in our face, because the bond yields have gone up. And I mean, I'm saying from the last 1 year viewpoint, not the last 30 days. The yields have gone up, and therefore the room for equity valuations to further inflate is very limited. What allowed Page to see such a strong re-rating was year after year 30% earnings growth. And what we saw last 2 days was one quarter blip where the valuations did not allow that. And that is what we have seen. My conviction on Page from the next 5 to 10 years remains very strong. Just that there is no room for valuation expansion. Business remains as solid as ever. 50% ROC, working capital has also been reduced further. Top line growth remains very strong, and competition is just not there in that premium innerwear branded space. So business is on a different footing, and valuations are on a very different footing right now.